You're listening to Seattle Real Estate Podcast.
Hey everybody, I'm Sean Reynolds, the owner of Summer Properties Northwest, Reynolds & Klein Appraisal, and your host of this episode of the Seattle Real Estate Podcast. Today, we're going to talk about interest rates, where they are, where I think they're heading, why I think they're going to go down, how low are they going to go, and what's causing them to drop. So let's jump into it. But right before we go into it, if you find the content here on the Seattle Real Estate Podcast helpful to your real estate business, to your home ownership, whatever it is, love to have you subscribe on YouTube. If you're watching on the YouTube platform, hit the like button for this video, hit the notification bell so each time that we put out content, which is daily right now, you'll get notified. And if you're listening on the podcast platform, make sure to share it with your friends and share the video with your friends as well. One of the news stories that I've seen lately is the chairman of the Federal Reserve, Jerome Powell. He's been talking about, it doesn't look like the economy is going well. Things are going to take longer to turn back around. The economic recovery might not happen as fast as we think. And when you've got a chairman of something as big economically in the United States and worldwide as the Federal Reserve chairman saying these things, tends to have an impact on the overall trickle down of how things go and interest rates specifically, because the Federal Reserve has a lot to do with kind of how the interest rates go. And specifically right now, they're doing so much to try and prop the economy up. So the news story that I saw was worried comments from Fed's Powell foreshadow even lower mortgage rates. And we've been hearing about this a lot, that in 2020, we're going to see rates drop under 3%. Are we going to get there? Why would we get there? Should we even get there is another question. That's what we're going to kind of focus on here. So worried comments from the Fed's Powell, Federal Reserve, and this is an article that I am reading from Yahoo Finance, and it comes from MoneyWise. And the beginning of the story is Federal Reserve Chairman Jerome Powell has been out again sounding the alarm about the potential for future damage to the economy from the coronavirus pandemic. In his newest remarks, he worried about the possibility of a second round of infections, which he said could bring a longer and more feeble recovery. The Fed's words and actions have been helping to push mortgage rates to one new low after another, and the chairman's newest statements could keep rates heading downward. So a lot of people are looking at this and going, oh yeah, if this is what he is saying, this is probably the trajectory that we are looking for. Now, will we have another round two of infections? I don't know. I'm kind of inclined to believe that in November, December, the flu will come back around and we will have some more coronavirus. Will we have another full-on episode? I don't know. I kind of don't think so. And even if we do, I think a lot of things are already prepared. They're already in place for, okay, we know how this goes down. It won't have as much impact as this first one did that happened the beginning of 2020. So I don't think it'll have as much impact. But if we did have another big outbreak, round two, that would not be good. Just as businesses are reopening and kind of getting going, to have a second round of this go through, that would not be good. And it would definitely damper any kind of economic revival going on. It would be just another drag on things, kind of like the protests and looting are right now. It's for businesses trying to open up. It's like, oh man, we were just about to get to the point where we're opening up, and now we've got this going down. Difficult for these businesses to do what they need to do, but it's just kind of part of owning a small business and doing what it takes to keep moving forward. All right, and we're still talking about Federal Reserve Powell. In his latest comments, Powell raised concerns about additional COVID-19 flare-ups. A full recovery of the economy will really depend on people being confident that it's safe to go out. I agree with that fully. The Fed said during a Princeton University webinar on Friday, this was last Friday, 28th of May, a second wave would really undermine public confidence and might make for a significantly longer recovery and weaker recovery. Powell's previous warnings have helped to push mortgage rates lower and lower, and his new words could bring more of the same. Economic worries often do move interest rates, and as one of the most influential economic policymakers in the U.S., Chairman Powell's words are very closely watched for future guidance. said Brendan Phillips. He's a capital markets analyst with the online mortgage lender Better.com. The ongoing fears about the economy have had investors flocking into treasury bonds as a safe place for their money. Bond prices have been rising, bond interest has been following, and mortgage rates have gone along for the downhill ride. You got to watch kind of the 10-year treasury to see where that is relative to mortgage rates. And I think right now it's at about 0.62, somewhere in there. Mid sixes maybe, 0.6 something. But that is a real reflection of where we are mortgage rate wise. And currently, if you look at mortgage rates, we're somewhere above 3. They're talking about FHA and VA being under 3, but I think most conventional 30-year fixed are over 3, maybe like 3.25. So, yep, and by historic standards, super, super low. Some of the lowest rates that we've ever seen. All right, here's another article, and this is from... This is also from MoneyWise. And helped by Jerome Powell and the Fed, mortgage rates below 3% have arrived. And what I wanted to focus on in this article is why rates are going through the floor. Fed Chief Powell has made a series of speeches and appearances warning the pandemic is beating up the U.S. economy like nothing the country has seen since World War II. The central banker is saying the economy may remain shaky until there's a COVID-19 vaccine. I think a lot of people are pointing at that and saying, yep, until we have a vaccine, there's no way to really get people out of the house and have them not be afraid of going out. Because if they go out and if they are infected and we don't have a vaccine and maybe they're predisposed or they've got an existing health condition, that could be the end of them. And that's a horrible way to go. And so I think a lot of people are just staying home, or maybe they've got a loved one in their family that has conditions that if they, were exposed, it would not be a good ending. So people are really hunkered down still, I think, even as a lot of these economies open back up. A lot of consumers, and we're a consumer economy, we need consumption to go on. And for a lot of these stores to open up, businesses to open up, need people out there. And until we get a vaccine, I don't think you're going to see a ton of people go back out. I think you'll see an initial wave of people go back out. But until we get a vaccine, I don't know. It just doesn't feel quite right that we're all just going to jump back into our lives previously without a lot of change. And that's where I kind of think we're at as far as that goes. Powell has been getting investors worked up over the potential for a drawn-out recession, so they've been moving into safer investments like bonds. The worse the economic forecast becomes, the more likely we are to see similar moves in interest rates in the future. So if we see a whole bunch of bad economic news, guess what? We're probably going to see those interest rates drop a little bit. I'm not sure how much further they're going to drop. I see a real resistance at about the 3% mark. Much under 3%. I think you might have some dips that go below there. So if you are in the position to refinance your home, more so than purchasing your home, because when you purchase a home, you go under contract, you say you're going to buy it in XYZ number of days. You need to have your financing ready to jump. Whereas with a refinance, if you're refinancing your existing mortgage, you can have everything already lined up, have your credit squared away if that's what you need to do, have your debt paid down, whatever it is that you need to do, be ready to jump. And then work with your mortgage broker, whomever your lender is, and say, you know what, I'm going to wait for rates to kind of see where they fluctuate out here. But when it's go time, it's go time. And most lenders will work with you that way. And they'll keep you informed. A good lender will keep you informed as to where rates are. So another major factor pulling down mortgage rates is the Fed's current program of buying up mortgage-backed securities to prop up the economy, said Frank Nathat. He's a chief economist with CoreLogic. So if you haven't been following right from the get-go, when the stock market started doing its crazy downward trend at the very beginning of the coronavirus outbreak, the Federal Reserve really jumped in, and they were basically propping up a ton of markets, including buying up billions of dollars worth of mortgage-backed securities. And that has the effect of basically shoring up the markets and giving kind of confidence to the markets, and also driving prices down on things like mortgages. It causes them to drop, and that's where we're at. And so those securities are mortgage-backed mortgages bundled together into investments similar to bonds. The Fed has been on a buying spree with mortgage-backed securities, and that's raising their prices and helping mortgage interest rates go down. So that's the kind of situation we've got. That is a lot of why mortgage rates are dropping. And then you've got the Federal Reserve chairman saying, you know what? This recovery might not go the way we want it to. It may take a lot longer for things to turn around, especially if we get another uprising of the coronavirus infections. So kind of you put all those things together, and that's why we've got some historically low interest rates. Let's move on to another really good article that I found that I thought covered a lot of ground. Will mortgage rates go down in June 2020? That's what a lot of people want to know. And this article was written in mid-May, and so some of this stuff is a little bit obsolete even now, 2 weeks later. But what we're going to do is we are going to jump down to predictions for June. June will be a wild ride for mortgage rates. In short, our predictions is that the rates are headed downward, with averages finally dropping below 3% for the first time ever by late June or July. I think that probably will happen, but when they say drop below 3%, that's usually for like a day or a handful of days, maybe a week tops, and then they bump back up. There's something that kind of keeps them right around that 3% or above rate. I don't think you're going to see them drop significantly under 3%. So if you're getting a rate quote for like 3.25%, take it. That's a great interest rate. If you're getting a rate quote for 3.5%, know that they might drop down to like 3.25%, maybe 3%. But if you're within that 0.25% point, I'm not a loan officer, I'm not a mortgage guy, but I just know that if you have a chance to buy a home or do a refinance with a mortgage rate with a 3 in front of it, that's an impressive number. Historically, that's an incredibly low number. Take advantage of it. Jump on it. Don't worry about getting that 1/16 of a point or an 1/8 of a point. Just jump in and do it. So the article here says, so today's rates are essentially the best they've ever been, historic lows. The bottom line is that rates could go lower in June and July 2020, but why would someone place that bet when they could capture a best ever rate right now, today? That's kind of, I'm saying basically the same thing. If you can get a great rate, jump on it. Don't worry about it. Don't worry that your neighbor over the fence might brag to you, oh, I got a 0.25 point less. Who cares? So what? Figure out your budget. Here's where your payments are. It's about you and your financial decisions and your house, the house you're buying. It's not about some other guy. Just do what's best for you. And if it's the right decision, then that's where it goes. All right, so now I'm looking at a chart. These are mortgage rate forecasts for the next 90 days. So the low in 2019 was 3.49%. So let's call it 3.5%. And that was in September of 2019. And then the low so far for 2020 has been April 30th. We were at 3.23%. And I think they might have dropped a little bit below that since then, since this article, and that's what makes it a little bit obsolete. But then the forecast of low by this article is 2.99% by July 2020. And then it forecasts basically a jump back up somewhere right, low threes, maybe 3.15, 3.2, 3.25, somewhere still super low. Because we are coming out of, a massive economic crisis with all the economies being shut down, I don't think you're going to see a huge recovery. The one exception to that is housing. That's the main exception, and you're hearing about that a ton. And I have people leave me comments saying, hey, you're a shill for the real estate industry. You own a real estate brokerage and a real estate appraisal company. Of course, you're going to try and pump up the news to make it seem best for what works for you and your businesses. And the main thing that I've been talking about is that there's a lot of demand out there. There's very little supply, and you've got these low interest rates, and now you're going to see them go even lower. I don't think interest rates under 3% are going to have that much of an impact on the marketplace, just because it's going to be for a short time period. Rates will probably drop back up or bump back up, but a lot of it has to do with how much volume can go through the system. Only so many loans can be locked. Only so many appraisals can be done. The system gets jammed up. Only so many loans can be bought by investors. and bundled up. That takes time, and you can only get so many through. So will you have opportunities throughout 2020, the summer of 2020? Yeah, I think you will. So be prepared and ready to go so that when your loan officer does call you, you don't have to monkey around with getting in tax returns and all that other good stuff that's required now with a mortgage. So moving on here, we've got the markets will focus on COVID-19 economic fallout. What does that look like? In the last 90 days, coronavirus and the disease it causes, COVID-19, has put entire nations on lockdown, slammed the stock market, and worst of all, created a serious health situation worldwide. It also brought the lowest rates of all time. So there again, that's what we're focusing on, is super low mortgage interest rates. And I know a lot of people outside of housing and real estate, they don't really care. They see those random news stories and they're like, yeah, interest rates are really low. Maybe I should check out refinancing. But for those of us in real estate, it's an ongoing thing that, oh my gosh, have you seen where rates are? This is crazy. Students of mortgage rate movements know that uncertain economic times often bring low mortgage rates. Super true. That's why shoppers should watch current events closely. No one knows how this situation will play out. The economy could recover quickly, and a post-quarantine boom could ensue. That might cause mortgage rates to rise quickly. We're not hearing as much about that because I think with, what do we have, 40 million Americans have claimed unemployment for the first time over the last 8 weeks, whatever it is. Unemployment rate is high. Mortgage forbearance, even though that's leveling out now, ton of people have had to enter mortgage forbearance. Just all kinds of stuff economically that is associated with when you shut down worldwide economies, especially one that's as big as the United States. Or the more likely scenario, the economy could struggle to recover. Never before has there been a sudden and all-consuming consumer lockdown of U.S. businesses. Even during the bleakest moments of the 2008 panic, you could still walk into a local bakery and enjoy a muffin. That's true. But even something as simple as now is unlikely, as many small and large businesses alike are closed or already out of business. So that's the difference between 2008 Great Recession and this one, is that a lot of places in the country are still locked down. We do not have dining in options here in the state of Washington. We will have some dining in, and I throw quotes about that around that because it's exterior only seating. You can only sit outside. And it's at, I think, 50% capacity of what the normal outside seating is. And that's even if the restaurant you like to go to has outdoor seating. A lot of restaurants don't. So big differences between the Great Recession and where we sit right now. All right, so here's this article's, our predictions, the first ever sub 3% average mortgage rates. And again, I think you will see this, but it'll be for a short period of time. History says mortgage rates should be about 2.85% right now. All right, I agree with that. But oftentimes you've got these barriers and mortgage rates don't drop underneath them. There's resistance at a certain point, and I think that resistance is about 3%. Yes, you read that right, 2.85%. But there are a couple of reasons rates aren't that low. Number one, lenders can't handle the volume. I just talked about that. There's only so much that can go through. We see that on the appraisal side all the time. We get to the point where we can't take on any more volume and not be weeks out in advance. And with interest rate locks the way they are now and the way appraisals need to get turned around quickly, if you take on something that you can't turn around, you're going to lose business because you need to be able to commit to doing an appraisal, go out, get it done, turn it back in, do it again, rinse, repeat. You just keep doing that. But if you take on a whole bunch of orders and you can't get to those orders, that is not good for your business. So the system, all appraisers, we can only do so many appraisals, and there's a certain point at which the system just kind of goes, yep, we're done. We got to take a little breather, got to take a little break. And we're not taking a break. We are working overtime to get the appraisals done, but the system can only handle so much. And the second reason is, reason number one, why rates aren't quite as low as 2.85%. The second reason is investors aren't buying mortgages at the expected rate. For mortgage rates to be rock bottom, there needs to be a huge demand from investors to purchase these low 3% and even high 2% mortgage bonds. Typically, investors buy mortgages as a safe haven when the stock market is tanking. That's not going on right now, is it? It's done a massive recovery. But investors are hesitant because, number one, they're afraid homeowners will refinance again, eliminating the interest earned. And number two, they're fearful of defaults and forbearances. Talked about that a little bit. As they're fearful of defaults and forbearances as coronavirus threatens people's jobs and businesses. I think we're at the beginning of June here. Today's June 2nd. Happy birthday to my brother Paul. Happy birthday. But the fear of defaults and forbearances, I think we kind of know what those numbers are. And we're at the point where those are tapering off. And I think the markets are recognizing, all right, we know it's bad and it's been horrific, but at least now we kind of know where we sit. Because we're on the other side of economies reopening and at least kind of getting the ball rolling. And so I think a lot of this is already plugged into the numbers that we are looking at. So that's kind of where we sit with mortgage rates right now. They're somewhere hovering right around 3%. Yeah, they could go under for a little bit, but I don't think it's going to be long. I don't think we're talking about 2.5% mortgage rates. If we are, that would be crazy. But unfortunately, that means there's probably some really bad economic news going on there, or the Fed is having to, use yet another one of their tools to kind of prop up the economy. And the reason they'd be doing that is because there's some kind of economic news or there's some situation going on that's a little bit outside of our control, and we're going to pull out all the stops to kind of do what we need to do. And those are the things that drive rates down, and that's where we sit right now. So if you're in the housing industry, you understand that mortgage rates are super low, and this is one of the few things in business right now that's really doing well. If you're a home buyer, you're looking at some incredible rates. Lock in those really low rates. If you're a homeowner with a mortgage that's got a interest rate higher than 3.5%, might be worth your while to take a look at a refinance, depending on how long you live in a home, what your plans are, what your overall goals are. And don't quote me on any of this stuff as far as the specific points in a mortgage. Leave that up to a loan officer, to a mortgage lender. Get a recommendation if you don't have one already. Find somebody who's been super happy with their mortgage lender. Get that recommendation from a friend, a family member, coworker, whatever. But get a recommendation so that you're dealing with somebody good. Because you want somebody good that's going to be able to tell you, hey, it's go time with your interest rate. Let's do this now. Let's pull the trigger. Let's lock it in and get you done. Because that's where you need to be. Because when you've got all this volume of lending going through, you got to really be able to react. So that's where we sit with mortgage interest rates, and those are kind of my predictions. I think you will see them drop under 3%, but not for a long time, and then I think you'll see them bounce back up. Beyond 2000, I don't know. You just can't really predict that long down the road, and that's only 6 months away from 2021, which is crazy, but things just kind of keep on rolling. So I hope you enjoyed this podcast. It's been a fun one for me to put together because making predictions, it's always interesting to see because you can always look back and go, man, I was really off on that one. But on this one, I don't think I am. I think we're going to be right around that 3%, and that's where we'll sit. Thanks so much for watching and listening on the podcast platform and on YouTube watching. I'm Sean Reynolds from Summit Properties Northwest, Reynolds & Kline Appraisal. We'll catch you on the next one. Thanks again. Bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.